Hello students, welcome to all of you Shiksha 360 JAP classes. Today basically we have to discuss the financial management and overview. AFB chapter number part 19 part 2. In the previous session we have discussed regarding the HUF, LLP, partnership firm and proprietorship firm. Next remaining part, that is AOP or BOI, company and cooperative society, we have to cover in this session. So first of all, we will discuss regarding the association of persons or body of individuals. It's very, very important to understand. I have take some examples also under that so that you are able to understand what is the actual meaning of that. Not only the definition, but the actual meaning. So an association of persons, what is that? It is a group of two or more people. Sorry. It is a group of two or more people who come together for a common purpose, such as running a business or carrying out a specific project. First of all, you have to remember that it is a group of two or more persons. So what is the motive of that? So AOPs are formed with the intention of earning profits, and each member shares the profits and losses of the activity in proportion to their respective contributions. How much they have contributed with respect to that, they have to share their profit or loss. If in the business they will get the profit, so they will share their profit according to that, and if they get the loss, so they will share their loss according to that. This is the thing they want to say here. Next one, that is body of individual. A body of individual, it is also similar to that it is a group of two or more people who come together for a common purpose. But unlike a AOP, a BOI is not formed with the intention of earning profits. So for what it is formed? BOI, body of individual, it are used for the management of property or assets, and the income generated from that property, it is distributed among the members. Clear? So BOI, what is that? BOI are used for the management of property or assets, and the income generated from that property. Clear? And the income generated basically from that property, it is distributed among the members. So how we can differentiate what is AOP and BOI? From their example, you can able to understand that. BOI basically used for the management of property or assets. Okay. So AOP basically from their intention to earn profits, like partnerships, joint ventures and cooperative societies. Partnership forms we have already discussed. Cooperative society we will discuss in the upcoming slides. What are the examples of BOI, body of individuals? Includes basically clubs, housing societies, charitable trusts. In a club, the members come together basically for what? To enjoy the facilities. Certain facilities. What are that? Like such as sport facilities. And the income generated from the facilities basically it is used to maintain them. Clear? That is to maintain the club. Clear? They have fixed price in such a way that is their daily usual expenses for maintaining that thing they will earn from these. Basically we can say that membership. Okay, so this is the basic difference from that. Now let's move further. Some other points which we have to cover here. In a housing society, the members collectively own the land and buildings and share the expenses and profits from them. Okay, arising from them. So these are some examples regarding the same. Now move to the next point. So AOP, there are some benefits. So an AOP, that is association of person, it is better suited for a business venture as it is formed with the intention of earning profits, and the profits and losses are shared among the members in proportion to their contribution. So on the other hand, BOI, on the other hand, are better suited for the management of property or assets where the income generated is distributed among the members. Clear? So where the income generated, it is distributed basically among the members. Next one point here, that is 6 point, that is company. We have to discuss in detail regarding the company as there are some specific chapters for the same. But here we will discuss in brief regarding the company. So what is that? A company, it is an association of persons who contribute money or money worth to a common stock and use it by a common purpose. Okay, so it is also association of persons. who contribute money or money worth to a common stock. Money worth that is equivalent to money. They are some providing some assets or other things. Okay. So company basically it is created by law and affected by law. Company, first of all, in examination, they will ask it is a legal person or not. Yes, company, it is a legal person, just as much as an individual, but with no physical existence. Clear, there is not any physical existence for the company. Further, that is Company Act also 2013 also permits formation of one-person company, which has only one person as its member. Clear, sometimes they will ask question also like in this way. Clear, any the basically the company act permits one-person company or not? Yes, it permits one-person company. Next point which we have to cover here, that is regarding the cooperative society. So this can also be the one form of a business organization. It is a form of business where individuals join hands for the promotion of their common goals. Mutual assistance and service are the main objectives of a cooperative society, as distinguished from the profit making aim of the other forms of organization. Clear? Cooperative society, that is, it is a form of business where individuals join hands for the promotion of their business goals. Like mutual assistance here and service are the main objectives of a cooperative society, as distinguished from the profit making aim of other forms of organization. A registered cooperative society, it is recognized as a separate legal entity by the law. Okay, so a registered cooperative society basically it is recognized as a separate legal entity by the law. If it is a registered, it acquires an identity quite distinct and independent of its members. It can purchase and dispose of its asset. That is, the society can do that. It can sue and can also be sued because it is a registered, so law applicable of them. The management of a cooperative society is vested in the management committee elected by the members of the society. Clear, the management of a cooperative society is vested by the management committee elected by the members of the society. So this is the complete discussion of the AOP, BOI, company and cooperative society. This is one question which we will discuss later. Next, we will discuss regarding the financial decisions in a form. First one, that is estimating the capital requirements, deciding the capital structure or composition, deciding on sources of funds. Okay. Under that, we have to discuss what is equity shares, use of long-term funds, corporate strategy, mergers and acquisitions, use of short-term funds, financial control, compliance, decision of dividend and the retained profit. Clear? So we will try to cover all these things in this session. So first one, that is financial decisions in a firm. What is the meaning of that? How we have to arrange the funds, where we have to utilize the fund, what is the requirement of the long-term funds, what is the requirement of the short-term fund, all these things. So financial decisions in a firm mainly relate to the acquisition and utilization of capital funds. Capital funds, that is basically used to create the assets in meeting the financial needs and overall objectives of the firm. Therefore, the primary function of finance department, clear? So therefore, the primary function of the finance department is to acquire the capital funds and put them to proper use as per firm's objective, clear? So therefore, the primary function of the finance department basically is to acquire the capital funds and put them to proper use as per firm's objective. So financial decision in an organization normally relate to the following things. First one, that is estimate the capital requirement. The capital requirement basically are estimated based on the organizational objectives. Clear, the capital requirements are estimated based on the organizational objectives. Depending upon the market share aimed by the organization, the investment is fixed asset and requirement of working capital, it is to be estimated. Clear, so the capital requirements are estimated based on the organizational objectives. Depending upon the market share aimed by the organization, investment in fixed assets and the requirement of the working capital is estimated. Fixed asset, that is for long-term capital, and working capital, that is for short-term or for day-to-day activities. Deciding the capital structure and composition. So this is one of the most crucial aspects of success of the organization in achieving its objective. How we can decide the composition of debt and equity, how much we will take loan and how much we will raise money from the market, plays a very important role for profitability and sustainability of the operations. A high proportion of debt may result in profit declining, clear, because we have to pay more interest to the bank also, clear. Or sometimes business is not going well, clear, so it leads to difficulty for the organization to pay the installments. That is why a high proportion of debt may result in profitability declining to dangerous levels, causing problems in servicing of debt and thus affecting the viability of the operation. On the other hand, a low debt may result in underutilization of the organization's potential. Clear. On the other hand, basically a low debt may result in underutilization. Clear. That is, we have not sufficient money to perform. Underutilization of the organization potential to earn the profit and provide reasonable returns to owner. Clear. So we have to maintain both the things that we will get profit in the organization. Clear. While working in the organization. For one, deciding on sources of the funds. Clear. So now, if we are starting to working, so how we can arrange the funds, clear, or how we can source the funds. So once the capital structure is decided, the best available sources, clear, first of all, we have to decide how much fund basically we will require, or basically where we will require the fund. So once the capital structure it is to be decided here, the best available sources for these are to be identified. For example, if more capital is required, it may come through equity or preference issue. The how we can raise equity? The equity could be raised through right or public issue or private placement. What is right issue? What is public issue? What is private placement? All these things we can learn through our sessions in the different subjects. In the PPB, we will discuss regarding that. The long-term funds can be raised through the public deposits, debentures, or term loans from the banks. Term loan basically it is long-term. Each source of funds has its own merits and demerits. Optimizing the firm's weighted average cost of capital while deciding on the sources of finance, it is one of the key objectives. Clear? Firm's weighted average cost of capital. Clear? That is how much cost like we have to pay for that capital. Clear? Like we can say that like interest and other charges for that. Like if we take the term loan, all these things they have to be taken. So here we have taken some words. I will discuss only one word. We have discussed here that regarding the equity or preference issue, right issue, public issue, private placement. Clear? So what is the meaning of equity shares? We will discuss here so that you are able to understand what is the meaning of that term. So while when investing in the share market, equity shares are a popular option for the investors. Equity share, what is it represent? That is, you have take some ownership in that firm. Equity shares represents ownership in a firm or a company, giving investors a stake in the company's profits and assets. Clear? If a company will earn the profit, they will share that profit with you. As an equity shareholder, you become a part owner of the company and are entitled to a portion of its benefits. Additionally, equity shares offer various benefits to the investors, including the potential dividends and the voting rights. These benefits are the features of the equity shares. There are several reasons why anyone give you share in their company. There are several reasons why the company issue equity shares. However, raising capital to funds their business activities always comes first. Clear? Basically, for the funds needed for their business activity, this is the main reason. Apart from that, there are some other reasons also. Apart from this, issuing capital shares help companies diversify their sources of funding. Earlier, basically, they have to take money from the bank only. Now they have different sources, like from the public also they will raise the money. Therefore, companies can raise funds from a wider pool of investors instead of relying solely on the loans or credit. Moreover, issuing equity shares can help the companies build their brand and reputation. Clear, if their company, like we can say that, like if any Tata company or Adani company basically will issue their shares. So people will purchase more. Clear, they have know the value of their companies. Depend upon company to company, not only these companies, there are many more other companies out. So by selling shares to the public, companies can increase their visibility and gain a large following of investors and supporters. Clear? Sometimes in the examination, they will ask also why companies issue the equity shares or what are equity shares. Clear? For the understanding purpose, you are able to understand all these things. So next one, that is use of long-term funds. Clear? Basically how we have to use of long-term funds. So the long-term investment decision or capital budgeting is amongst the most crucial financial decision of a firm. It relates to the choosing from amongst many options of a capital assets or investment proposal. Okay. It relates to the choosing from amongst many options of a capital assets or investment proposal whose benefits are likely to be available in future for a long time. Clear? So use of long-term fund, that is basically purchased to the capital assets. Capital asset, like basically it is used for the machinery. That is basically which have tenure of, we can say that, more than 1 year. Clear? Long-term funds. Clear? Even they are using for 10 years, 15 years, 20 years, machinery like that. The long-term investment may relate to acquisition of a new asset or replacement of old assets. Such a decision basically will depend upon the relative benefits and the returns associated with the project. Appraisal of an investment decision from the point of view of return on capital employed is this necessary. Various techniques, we have to cover all these things in the accounting. That is how we have to calculate IRR, interest rate of return, net present value, payback period, etc., or amongst the methods for investment decision. Clear, like how after how much period we will get our amount back. Clear, like on the way of investing. Clear. Seeking the best risk adjusted returns, it is one of the key objective of this exercise. Clear. So in the examination, they will ask like use of long-term funds. What are the techniques which we are used for checking the best methods of investment decisions? Clear, for checking the methods of for investment decisions. Clear, all the things we have to cover here under the long-term funds. Next one, that is corporate strategy or merger and acquisition. So what are that? So the corporate strategy on growth of the organization may involve both organic and inorganic growth. What is the meaning of that here? Organic and inorganic growth. Organic growth, that is, means expansion of business by creating additional capacity by adding more fixed assets. Kindly remember that in the examination, they will ask these types of things. So organic growth, you can see that what is the biology things they will ask in the accounting. Clear? So organic growth here, what it means that expansion of business by creating additional capacity by adding more fixed assets. On the other side, inorganic growth, that is basically means acquiring the business of other firms. Okay, so this is the meaning of that acquisition. So this route of merger and acquisition for expansion has the benefit of time. As creation of fresh capacity, it is time consuming and there is more money requirement also. So an additional benefit may be reduction in competition if the target firm in the same business as the acquiring firm. Clear, an additional benefit may be reduction in competition if the target firm. Clear, that is if both which from basically the other organization through which basically we want merger or we want to acquire or acquisition that organization, if it is dealing in the same business, so it will lead to a loss. So we will like we are manufacturing the tires and we will take rubber from any other organization. Clear? So we will acquisition or we will merge with the other organization that is doing the work in the field of the rubber. Clear? So both rubber and manufacturing will be done at the same place. Clear? Like this type of strategy will work. Okay, so this is the meaning here organic growth and inorganic growth, you can also able to understand. Next one, that is use of short-term funds or working capital management. Clear? Short-term fund, that is for day-to-day work. Working capital management, it is concerned with the management of the current assets and liabilities of the firm. The major task in the working capital management is the trade-off between the profitability and the liquidity. These two are inversely related to each other. Liquidity, it is also necessary for running the business. Liquidity, it is an important requirement for sustaining the operations of business. The working capital should be available adequately. Clear? The working capital should be available adequately for the sustained operations. At the same time, too much idle cash is considered. Clear? At the same time, too much idle cash, like we can say that abundant cash available with us and we are not using that. This is also not beneficial. At the same time, too much idle cash, it is considered to be an inefficiency in financial management and it is a waste of the precious resource. Clear? So we have to manage our daily task in such a way that we can use our liquidity and we have not abundant of cash in our hands. Last one, that is financial control, compliance, and decision of dividend and retained profit. So the financial control, the function of financial management does not end with the raising and utilization by resources. There is a need to continuously monitor all the financial activities to identify any area of inefficiency, clear where we are not efficient, and take corrective action in that field. Many techniques like ratio analysis, we have already discussed in detail regarding the ratio analysis and the numericals. Costing, complete module D, budgetary control, etc. are available for this purpose. So what are the techniques for the corrective action or identify any area of inefficiency in the financial control? So these are the techniques: ratio analysis, costing, budgetary control, etc. Clear? So you have to be understand these things. Why basically we are studying these things? Sometimes like you are renewing or creating a new CC limit, so you have to be check all these things very properly. Or while renewing also you have to be take more care. Next one, that is compliance. The scope of the financial management also includes ensuring compliance with the statutory and regulatory provisions regarding the capital markets, audit and accounting, disclosure, taxation, etc. Clear? All these things under the compliance. Last one, that is the decision of dividend and the retained profit. So keeping in view the organizational objectives. Okay, so keeping in view the organizational objectives and the interest of the shareholders, a decision about this expected. Normally, the firms distribute some portion of the profit and retain the remaining for expansion or other financial needs of the firm. Okay. So normally the firms basically distribute some portion of the profit and retain the remaining for expansion or other financial needs of the firm. So sometimes company basically decide to benefit shareholders. How? Basically through buyback of shares, like they will purchase shares again at this price, or instead of paying dividend. Clear? As the dividend is taxable in the hands of the shareholders. Okay, so it depends upon case to case. So here one question arises: buyback of shares, you will get the money back, your money back. So that money, it is taxable or not? So you have to be search on that and give answer in the comment section. Clear? So this one, it is the question arises here. So why the company will buy back the shares? That is to benefit you in the tax or any other decision or any other reason behind that. Clear? So you have to be take care regarding that and you have to comment in the comment section. Clear? So next one, only one part is pending, that is fundamental principles of finance, which we have to cover in the next session along with some of the objectives questions. Clear? MCQs we will cover in the next session. So thanks to all of you for joining this session. So you can join for PPB, accounts, retail and Indian economy. Regular sessions will be provided to you and definitely you will clear the exam in the first attempt if you regularly attend all the sessions and practice MCQs. So thanks to all of you for joining this discussion.